Should you make the 20% down payment on a home or pay the monthly PMI? Many people want to buy a home before they saved up the 20%, but if you have the 20% available and are wondering if avoiding the larger down payment and investing it instead and paying the PMI is a better financial decision, I will break down the numbers here. So if you put less money down, you will have a higher mortgage as well as the PMI, but will also have more cash to invest. Let's look at whether the investment returns could outpace the added monthly charges. From 1928 to 2021, with dividends reinvested, the S&P 500 had an average return of just over 10%. And in the same time period, home values in the US rose at an average of 4.2%. These are both nominal returns, so neither of these are adjusted for inflation. These might be aggressive going into the future, but they're the historical averages, so that's what I'm going to use. For this scenario, we'll have two buyers of a $200,000 home, with both having interest rates around 5.6% and a 30-year loan. The 5% down payment buyer will put $10,000 down, and the 20% down payment buyer will put $40,000 down, so an extra $30,000 out of pocket. There are times you may be given a higher interest rate if you put less than 20% down, but this isn't always the case, and I want to make the comparison with the other variables the same. The average PMI is between $30 and $70 per month for every $100,000 of home value, so we will assume the 5% down payment buyer will have a monthly PMI of $100. So the 20% down payment buyer will have a total loan of $160,000, and the 5% down payment buyer will have a loan of $190,000. Because the loan is lower, the 20% buyer will have a mortgage of $918, and that's their total monthly payment. I won't be factoring in insurance or property taxes in this scenario. And the 5% buyer will have a mortgage of $1,090 plus the $100 PMI for a total monthly expense of $1,190. Which is $278 more per month than the 20% buyer. The 5% buyer would have the $30,000 to invest from day one, while the 20% buyer would have zero. However, each month the 20% buyer would have an extra $100 from not paying the PMI, but another $178 from a lower mortgage payment to invest. So I will be assuming they invest both of those amounts per month and get the same return on the S&P that the 5% buyer gets on their $30,000. If we assume the home appreciates at the 4.2% long-term average of real estate in the US, combined with the principal being paid down, it will be at just about 3 years when the 5% down payment buyer would have 20% equity and could stop making the monthly PMI payments. So let's compare the two buyers at this point. The 5% buyer, having invested the $30,000 savings from the down payment and assuming the long-term average growth rate of the S&P, would have a gain of $10,500 after 3 years. And including the appreciation and principal payments on the home, they would have equity of $51,000 for a gain of $62,000. The 20% buyer would have $4,000 from having invested the PMI savings per month. They would have equity of $79,000, and they would have saved $9,500 on lower interest payments since they had a smaller loan. And they would have a gain on the difference in the mortgage payments that they are investing each month of $1,000. This is just the gain and not the added up differences in the payments each month, because that is included in the higher equity and the savings on interest payments. And then we'd subtract the added $30,000 for the down payment they paid in comparison to the 5% buyer to compare their gains against each other. So the 20% buyer's total gain is $64,000, which comes out about $2,000 better than the person who made the lower down payment, which is not as much as many people would think. But at this point, the 20% down payment buyer could refinance, pull money out, and have more money to invest than the 5% down payment buyer, and end up even further ahead over the next 27 years. But let's assume they don't do that, and let's compare who would come out ahead after 30 years from here. While the PMI stops after year 3, the 20% buyer had the $4,100 after the 3 years of investing it, and that amount would end up being $62,000 over the next 27 years if it were put in the S&P. If they were investing the difference in the mortgage amount each month, they would have a gain of $330,000, and then they'd have savings on the interest paid of $32,000 for a total gain versus the 5% buyer of $424,000. I'm not including equity in the home, as each of them will have paid off the home by year 30. The 5% down payment buyer, if invested the $30,000 over the 30 years, would have $601,000. So the 5% down payment buyer would end up ahead since they had more cash to invest over the long term, along with the PMI having gone away after the 3rd year. As I pointed out, if the 20% buyer after year 3 used their extra equity to pull cash out and invest, then they would have more than the 5% buyer. And this exercise just shows that there's an opportunity cost when paying off a loan, and the S&P has historically returned more than the cost of interest rates. While you would gain on the appreciation of your home, regardless of the amount of down payment you made at the beginning of the 30 years. That's the video. Like, subscribe, whatever.